Are you looking to make weekly or monthly income? In this video, I'm going to talk about doing covered calls on stocks to make weekly and monthly income. I'm going to go over an example, and I'm going to pick some stocks that I believe are some of the best stocks to running this strategy right now. Throughout my experience, I think covered calls are literally the best strategy to use. I spoke to a financial advisor who manages NBA player money. This was back in college when I was studying finance, and he basically only uses strategy to grow the wealth of NBA players. So I want to talk about the do's and don'ts and what you must avoid when running the covered call strategy. Because if you don't do it correctly, you can still make money, but you won't make as much money and you will end up losing your. And that's because when you're doing a covered call, you have 100 shares of stock and then you sell a covered call. And if that covered call goes into the money, and let me just show you an example, if it goes into the money, then you're going to end up losing your stock. So I like NIO right now. Specifically, I've looked at the chart. The chart looks absolutely delicious, insane. I mean, this stock was over $50 per share. And since then, it has basically taken the staircase and sometimes the elevator down. I mean, this stock went from 55 to 45 in just a matter of a couple of weeks. And then since then, the stock has really been struggling, but you know, it is a falling knife, but at some point it is time to buy the stock. And for me, I want to be invested in China. I want to be diversified, especially what's happening with the dollar. A lot of countries may go away from the dollar, and that's going to hurt our US dollar a lot. So I do want to be invested in China and other currencies out there. And specifically, NIO is very interesting because I think it's one of the best EV stocks. There's Tesla, there's NIO, but for me, NIO, it's a homegrown Chinese company. China wants it to succeed. China is on the back of NIO. So for me, I really like NIO. And as you can see, the moving average is continuously just going down. And currently it's sitting at 14. And NIO is sitting at $9.27 per share. Now, if I go to the 3-month chart, you'll see why I really want to do the covered call strategy on this, because NIO goes up and down and it fluctuates, but there is a very strong double bottom at 825. And what you have to remember about the covered call strategy is that it's a bullish strategy, okay? When you're doing a covered call, you are buying 100 shares and then you're selling a call option, as I'll show you in an example. But when you own these 100 shares, you don't want them to pull back, because if they pull back, then you're going to end up losing money. So this is a bullish strategy, and you want to find a stock that has good support. And for me, NIO right now, $8.25 is the bottom, $8.26, and currently it's sitting at $8.33. So I feel very, very comfortable that there is a strong support in place for NIO. And if I run the covered call strategy, at worst, this stock will probably go sideways, and then I'm going to end up making money on the call options that I sell. Now, if the stock bounces up, let's say to the moving average of $9.33 or just $9, then I'm gonna end up selling the stock. And that's why it's really important to pick the right strike price, because if I sell 8.5, I might end up leaving money on the table. Like, let's go into my portfolio and go to trade NIO options, and let's take a look at the premium. And let's talk about picking the right strike, because this is very important. If you don't pick the right strike, then you are leaving money on the table. And if you pick out a strike that's really far out of the money, then you're just not collecting enough premium. So you really want to find that sweet spot. So let's go to expiration. I'm going to go to an expiration day of May 19. For me, I want to pick an expiration date that's between 1 to 6 weeks. A lot of my students will ask me, well, why don't we just do weekly trading? Why do we have to do monthly sometimes? And the truth of the matter is, it actually doesn't really matter. You can pick an expiration date that is 1 to 6 weeks, because regardless, there's a very fast time decay. All right, so I'm going to look at the May 12th because the May 19 wasn't really populating, since I am doing this before the market opens. Now check this out. You can sell the 8.5 covered call option, and that's great, right? You can make $49, which is an insanely high return. This is basically a 6% return, because 6 times 8 is 48. So this is a 6% return in 19 days, less than 3 weeks, guys. This is how you build up a portfolio. You collect a lot of income, passive income, consistently and safely, and that's how you grow a portfolio, whether you have a small portfolio, a medium portfolio, or a larger portfolio. Sticking to the safe strategies like covered calls is basically what I do. I sell puts, covered calls, and I run the wheel. These are my top 3 favorite strategies. Now check it out. If I sell the 8.5 call option, that's fantastic. I'm collecting a lot of money. And if I look at the delta, it is 0.48, which is really high. Now, that's not necessarily a bad thing, but what is going to happen is if over the next 3 weeks NIO goes above $8.50, I will have to lose the stock at $8.50. So if it goes to $9, I won't be able to capture all of that movement on the upside. I won't be able to capture the capital appreciation. So my sweet spot here would probably be about $9. If you go to $9.50 and I expand this, you'll see that the delta is 0.24. However, I am not opposed, based on the technicals, as you can see here, that it is probably not super likely that in the next 3 weeks, NIO will explode that much higher past $9.50. but it's likely to reach about $9 per share. And that's why rather than selling the $9.50 covered call, I'd rather go for the $9 covered call because this is right in the middle. And if I expand the delta, it's 0.34. This is a great delta to do covered calls. 0.34 is right between the area which I like of 0.25 to 0.4. Now there is a big difference, guys. I sometimes do go 0.4. I only do that though specifically when I have a stock that has a really high dividend. So I call this the double dividend strategy. Sometimes I will do covered calls on something like Kraft Heinz. So Kraft Heinz, for example, let me show you what Kraft Heinz looks like. I like to do higher delta covered calls on Kraft Heinz, and I'm starting to get into this strategy because I call it the double dividend strategy. Specifically, if you take a look at Kraft Heinz, the dividend right here is 4%, which is really high. This is almost double or about double the S&P 500. And interesting, from Pennsylvania, I'm from Philadelphia originally. So if I take a look at Kraft Heinz, the price to earnings ratio is pretty low, it's 20. So this is a very good value stock, okay? It's not going for a very expensive valuation, has a very high dividend yield, and it does not have that much volatility. So despite it looks like it has a lot of volatility, in the past 3 months, it's only down about 2%. So this stock is not a big mover. In the past year, it's down 10%. So that's fantastic for running a covered call and a double dividend strategy, where you can basically buy a company that does not have a lot of volatility and it has a good dividend yield, and then you can sell at the money covered calls. Now, let's talk about at the money and the best practice here, because it's very important for increasing your returns and managing your risk, guys. I talk about this a lot on my channel, which is basically how do you manage a position? And nobody really talks about this because they don't understand it. They don't have a finance degree or actual experience. A lot of people are just making videos based on what they read on Google, or they're using ChatGPT, which obviously I don't really use. I'm actually giving you real information. If you appreciate that, please drop a like on this video. But I really want to focus a little bit on psychology and the benefits of strike selection, because your strategy does mean a lot, especially when you're looking at your profits and your losses. You can increase your returns a lot and you can decrease your risk. And if you can just do that by a few percentage points, you're making a really huge difference in your portfolio. So check it out, Kraft Heinz, I have an average price of $39.42, okay? So I ended up buying 200 shares of this position, and then you'll actually see that I've done something really, really interesting. I've actually sold 2 different covered calls. Now, there's a really big difference here and we need to talk about it. Okay, so the first covered call that I sold is very short-term in nature. It's expiring in just 5 days, okay? So this option right here is a weekly option. I ended up selling a 39.5 covered call. So as you can see, my average price is $39.42. I ended up selling an at-the-money covered call for $39.50. Now, why did I do this? Why did I not give myself more room for upside? And the reason is because Kraft Heinz is not really moving that much, okay? There's a difference between NEO stock, which has more volatility, and then Kraft Heinz, which is a very stable stock. Warren Buffett owns it. So this company is not moving a lot. And for that reason, I want to do closer to the money covered calls. And in fact, if I look at this, the delta, it has changed slightly because I've had this position open after I opened up in Discord a couple days ago. But this position right here has a very high delta, 0.37. In fact, it was a lot higher before Kraft Heinz started falling down, because it has gone down by about 2% in the past few days. But I decided to sell an at the money covered call because I wanted to collect the most amount of premium. So the premium is the highest the closer to the money you go. So as you can imagine, if I were to pick an option that's very far away, it's not going to have much premium. But I don't mind going very close for Kraft Heinz because I don't expect it to have that much movement. So I can basically bank on 2 things. Number 1, the dividend, and then number 2, the call option premium that I'm collecting. Now, the next thing that I did, because this is low management and pretty good return, is I ended up selling a July 21st covered call. Now, this is a few months out, but what I decided to do was go out a little bit higher to $40 per share. This is still not that much higher. It will give me about 1 or 2% upside in capital appreciation from the stock itself. But what I'm really banking on is, again, the dividend, and I collected $1.10 in premium. Now, $1.10 in premium is actually a lot, because this is $110 in premium that I've collected on just a $3,900 position. So this is about a 3% return, plus I'm collecting dividends, plus this is very low volatility. So this is a fantastic retirement strategy. If you have a little bit more money, you can absolutely do safe companies where you sell covered calls. Now, it doesn't matter if you have a small account either, because with a small account, this still makes sense, because I'm all about consistency, growing your portfolio slow and steady, getting rich slowly. I'm not a fan of doing anything risky or buying strategies, because those strategies are not consistent. They end up losing money, you end up being stressed, and that is not the point of how you want to grow your wealth using options. My psychology is I'm always after safe, passive income, And the covered call strategy is one of my favorite strategies because it's safe, it's passive, it's consistent. And I can also do the double dividend strategy, which is basically picking low volatility companies and then using covered calls to generate income on them. Now, I do want to talk about different scenarios and give you some tips, because if you can watch out for the factors that are affecting the stock, then you can actually avoid a lot of losses. So for example, let me go to something like Oatly. Okay, we can use a number of different examples, but when a stock has really strong momentum and it's going to the downside, what you actually may want to do is you may not want to hold your covered call until expiration. Typically, I do hold my covered call until expiration because I get the biggest raw return, okay? So I typically open a position and I don't even touch it. I just let it expire. And you can actually see that I'm doing the covered call strategy on Oatly. It's going very well. In fact, I'm up $1,000 on a very small position. But I will tell you, when a stock is going in the opposite direction of where you want it to go, and it just continues to go down and it hits a certain threshold. So for me, that could be 5% or 10%. It just really depends on the technical analysis. So let's just take a look at NEO again, for example. It has a really strong support at 825. But for example, let's say that this goes down a lot and it breaks support and it ends up falling. To be honest, I don't even know where it would fall because it's already such a value stock. But let's just say that it goes down to $7. Well, in that scenario, what you're going to want to do is actually roll your strike lower. I won't actually hold the position until expiration in that scenario. So as you can see now, I have a lot of different option positions in my portfolio. I have American Airlines, which I'm doing a covered call. This has been my bread and butter for a very long time. Basically every single 1 to 2 weeks in my Discord, I'm opening up a position on American Airlines. I'm selling covered calls and I'm usually collecting about 1 or 2% in premium. So I have that on American Airlines. I have Kraft Heinz. I'm just trying to look for an example where my covered call has made a lot of money and I may want to roll it down lower because the stock most likely fell a lot. So I'm trying to find that example. If we find a example, I'm going to open that up. So let's take a look at maybe Alibaba. So let's actually finish the positions that I have. So I have Alibaba 88 call. Other covered calls that I have currently in my portfolio looks like Oatly. I also have SPY. So SPY could be a really good example for us. Yeah, let's go into SPY. SPY is a perfect example because I have a lot of money in SPY. Specifically, if we take a look at my position, I have about 85% of my portfolio in SPY at the moment. This is basically the rock and the stability in my portfolio, kind of like the anchor, because I look at SPY for diversification. I have a lot of money at this point, right? $2 million. So I don't want to invest my entire $2 million in a single stock. So what I do is I make my life a lot simpler by investing in the S&P 500. And I also have single stocks as well, but S&P 500 is really my anchor and it provides me income because I am doing the covered call strategy, hence the title of this video, on SPY as well. So as you can see, a big position on SPY, 84.5%. 3,000 shares. I have $1.2 million. And what I want to point out is that the current stock price is $412. And the position that I have right now is the $419 covered call. Now, if you'll notice that if SPY goes down, my covered call is benefiting. So if I expand this covered call right now, I want to show you something really interesting about managing and also rolling and adjusting a position to make more money with it using the covered call strategy. So the 419 covered call is what I have right now, and you will notice that I'm up $3,420. Now, this is interesting because SPY is falling down, and obviously my covered call position is benefiting. It's creating income. It's decaying, which is fantastic because when you're an option seller, you want the stock to basically stand still, potentially fall down a bit if you're doing the covered call strategy, but ideally it stands about still. So that's exactly what SPY is doing, and that's exactly why I've been making so much money on SPY. It's very stable.
Hey guys, it's Henry. Before I jump into the video, I want to let you know that I'm personally taking my own calls now. It's the first link in the description. It's going to be a call with me about my Discord community, my trades, and my coaching. I, again, will take those calls personally for a limited time, so go ahead, schedule your slot if there's still time on my calendar, and I'll talk to you about my Discord community. Let's get into the video.
And this is a really good strategy specifically for smaller portfolios. So if you have a smaller portfolio, essentially this is really good because you get to like leverage your money. I'm gonna be sharing my screen right now as we speak. As you can tell, my videos are unscripted. I just shoot at random because I'm transparent. I don't really have a script. I don't really plan this out. I just wanna educate you, and I've been doing this for a very long time. So I don't really need to practice any option trading or practicing for this. So there we go, the screen share has started. And basically here's my portfolio. It has gone down a little bit because obviously the market has pulled down, but also I've been taking out money because I have two portfolios. Essentially, I have two portfolios because I want to diversify amongst different brokerage accounts. But one position that I'm super heavy on right now is Apple. But the poor man's covered call that we're going to talk about is going to be on Starbucks. So I want to look at Starbucks. I've actually done quite well. I don't typically open up poor man's covered calls, just to be honest with you, because I have a bit of a bigger portfolio. And at this time, like, I'm basically just like coaching. A lot of trades I make is for the Discord community because it's for other people. Like, I don't really care about making like $351. I mean, it's nice. I like money too, but I want to be really efficient with my time. So I don't really want to open up too many positions. But if I had a smaller portfolio, I think this is one of the best strategies that I would be using. And to be honest with you, I did this strategy quite a lot when Tesla was going up in 2020. So I was leveraging my portfolio quite a bit. So as you guys know, if you watched a lot of my videos, you would know that I took like 100K to 700K with Tesla. So I'm being like transparent and honest that like I did go pretty heavy on one stock. So it was definitely a risk, and I wouldn't like really recommend that risk for everyone. But if you will use the poor man's covered call strategy, you could put a lot less money down. So if you look at my history here, I put down like $4,380. I'm not the biggest buyer of options, but when I do buy, I want to be really certain, because I hate being wrong. Whenever I like make trades and like I'm wrong, then obviously, like I have a couple thousand people that are following me. So like it's really upsetting when they lose money. So I try to be very careful. And that's why I prefer selling strategies. I prefer like consistent passive income, both for myself, but also, I mean, I guess we're all kind of selfish, but in a good way. Like, I don't want people to have problems because then they're going to bother me, or, I just feel bad for their money, right? So that's why I chose to have like a consistent, safe approach, just because like it's the least amount of headache for them. It's the least amount of headache for me. I think it's just beneficial. Like, this is the way I trade. This is the way I decide to live my life. I decided to make less money and not go for the craziest returns. Like, I don't know, like maybe my $2 million portfolio, I just say 2 million. I have like a couple portfolios actually. So it's multiple, they're both 7 figures. But I decided that I was gonna aim for a bit smaller like return, but I wanted to be more consistent. I can aim for 10% a month, right? And I can make $200,000 off one portfolio, but that would require me to be an active trader. And to be honest, like I don't really spend that much money. So like, what do I need $200,000 for? I'm trading my stress and my health for money, and I'm just not interested in that. I don't really care. Like, my health and my mental health is much more important to me than money. So if I can just make like even like 2% on 2 million, it's $40,000. Like, I'm gonna take that. I'll take $40,000 over 200,000, because for the $40,000, I'm literally doing nothing. I literally do nothing. I just trade Monday and Wednesday for 45 minutes on camera for the Discord. And if it wasn't for those guys, I would trade for like 5 minutes, like Monday and Wednesday. Okay, maybe 10 minutes, but it really wouldn't take me that much time. I decided to do a buy strategy on like Starbucks. So it's a 2-order strategy here, but it's really a poor man's covered call. So the poor man's covered call essentially entails like I bought a Starbucks $80 call option. So I'm long, 80. It's going to expire essentially on April 19th, 2024. So this is quite a bit out. Actually, not really. It's only 6 months out. So this doesn't even count as a leap option. I know all those keyboard warriors can be like, well, there's not a leap option. It's 6 months. Well, that's true. It's technically not a leap option because it's 6 months. So it's just a call option, but it functions kind of like the shares, because instead of owning shares, like I have a call option that's kind of functioning like that. And then I ended up selling a Starbucks $95 call option. So that's kind of like a covered call. But obviously, like if I bought 100 shares and I did one covered call on Starbucks, that would be $9,267. So that's like quite a bit, right? So like that's quite a bit, versus like I'm controlling 300 shares, like 3 times that, and I'm also only put up like $4,300. I put the same cost as 50 shares, but I'm controlling 300. So I have like a 6x leverage factor. So I have like 6x the exposure with only a few $1,000s. Essentially, I opened this up on October 2nd. So that was like 7 days ago as I'm making this video. But of course, if you're watching this in the future, all my videos are just educational, right? I don't really make news content because it makes more views and I can cover the latest news, but I'm doing this for education. I want to educate you guys. I want to be a mentor and a coach. That's what I find meaning and passion in. So I don't really care if I get less views. I'm not chasing the YouTube hype as many YouTubers are. Okay, so I think, this Starbucks poor man's covered call is a really good position, even though I'm making this video like 7 days later. In 7 days, I made $351. So that's like $50 a day, including the weekend. Yeah, I'm up 8% so far. So that's really good. The stock didn't even have to go up that much. So let's just see in 7 days, how much did Starbucks go up? Okay, so it went up by 0.82, but I'm up like 8%. So I got like a 10x return factor. If you'll say it like that, basically it's like a 10x, right? So wherever the stock returned, I made a really good premium. I made a really good return, good profit. So I could just close out this position. I won't though. So I typically do like to, when I open up positions, I like to do a lot of, no, what am I saying? I don't like to do a lot of work. I'm very lazy, okay? I become very lazy. I don't really care about money. I don't really care about, I just want to get like myself and other people good results with putting in the least amount of work. So I'm trying to get like the highest Sharpe ratio. Okay, a Sharpe ratio is basically like get a high return for a really low amount of risk. That's really good, right? So you're getting like 50% return and it's like just a straight line up. That's like amazing. Some people get a 300% return, but it's like they went broke and they went bankrupt. They lived on the streets and then they made it, right? Like I don't want that. I just want like slow and steady wins the race. Like I want it to go up, 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 and then I can like withdraw if I need to, because obviously like I travel a lot. I'm in my 4th year of travel. So I'm in Eastern Europe. It's a lot of my roots are from here. I speak Russian and I actually speak some Spanish because I used to live in Colombia. But essentially, I want a slow and steady approach because that's kind of like the income that I'm withdrawing and I'm living on that. I don't need that much to live on. I mean, like $8,000 to $10,000 is enough per month because I don't have a family yet. So a position like this is really good, and essentially what I want to happen is if I click into this, I want the short call to expire. So I want the 95 call to expire, and I want Starbucks to stay, ideally below 95. But ideally, what I want to happen is I want Starbucks to rise just a little bit. Okay, so in the next looks like 11 days, right? Because this is going to expire in 11 days. Again, just think about the logic. Obviously, you're going to watch this in the future, so just think about the logic. The option is going to expire in a fairly short amount of time, so it's going to make me $63. But there's 3 contracts, as you can see right there. So 63 times 3 is 189. So it's $189, and essentially that is what I'm going to collect in time decay. So that's like the options expiring and decaying. So $189 is pretty good in like essentially like a week, because there's also going to be a weekend. So that's like $25 or whatever per day. And then this option right here, this 80 call, could also increase in value. So if Starbucks goes up, it's going to increase. So I really like the poor man's covered call. In fact, I haven't done enough of these, and this is something that I'm probably going to mix in more again for you guys and for my Discord community, because I think it's a very overpowered strategy. I think you can do really well, and $351 is really good on $4,380 in a week. So just imagine if you had $43,000, that would be $3,500 this week. I can bet you most of you guys are probably not making $3,500 per week, even in your job, because that's like $14,000 a month. Unless you live in California, New York, Miami, Houston, Chicago, unless you're living in these cities and you have a good job, you're probably not pulling that in. And even if you are pulling that in, you can be pulling in another really solid income by trading options. So for me, poor man's cover call is amazing, and I would probably do this strategy on just your expensive stocks. So something like Tesla is fairly expensive. Actually, I just opened this position up today, so that's so beautiful. So check it out. This is a put credit spread. I'm going to move on from this in just a moment, but you can see it 7 hours ago. I opened up a put credit spread for $351 in collected premium, and out of that premium, I've already made like 36% of it. So $143 just today. That's just a $5,000 small account trade. So the only reason I really did this is because I have my coaching call and I want to make trades, because that's what I do. Like when people join the community, they get access to me and then they get all my trades, and I'm just growing small accounts over and over. So I'm taking like $5,000 to $7,000. I'm trying to scale it up to like $10,000 to $15,000. And there you go, $143 today. But anyways, I wanted to talk about the poor man's cover call. So that's a put credit spread, right? I made some videos on this channel you can check out. Poor man's cover call is going to be buying a call option. I can go out into the future. So let's just say I'm going to go out 256 days into June 21st of 2024. So let's go into an in the money options. Let's see if I go to 210. That's a high delta. Delta's 0.78. Implied volatility is 54, so it's not little. Surprised there's some volume here. So a lot of people are trading Tesla quite out into the future. This right here, as you can already just see, okay, so controlling 100 shares of Tesla is going to cost $25,800, okay? And for example, buying this call option is going to cost $7,660. So it is a lot less that you have to put up. It's in fact about 1/4, roughly 1/4, right? Because it's a little bit more than 1/4. It's like 30%. So 30% of 258 is going to be like 7,680, maybe 7680 or something like that. So this is essentially about 30%. So you're only putting up 30%, and you can still, so for example, this basically counts as stock, right? So it's a long leap option, and now I can sell like 30 days out. For example, like November 10th, I can sell like 30 days out covered call. So let's just say I'm going to go ahead and sell the 280. Okay, so if I sell the 280, boom, now I can start making $800 pretty good. So I can start making $800 on 7,600. So that's like a 10% return in 30 days. So that's how you can get some really juicy returns, like 10%. Plus, to be honest, that's just the premium. So if the stock actually rises towards 280, again, your 280 call is going to expire. Okay, so it's going to be kind of, you know, gone in 30 days. Let's say the stock goes up to 275. This call option is going to gain a good amount of value. So you're going to make 805 plus, for example, like this 210 call option. So let me just show you. Actually, you can see right here. Basically, it's going to look like this. If it goes up to like 275, you're gonna have a profit of like $1,900. So you're gonna make 800 off of the short call, like fully in premium, and then you're gonna make another 1,100 and just the value of the 210 long call that you have. So that's how you can just, you know, make 10% from the short call that you sell. So the short call here is a 280, and then from the long call option, it can go up in value. So it can you know, rise by like $1,000. So essentially, yeah, like it says you can make a max profit of 2,180. Obviously that's like in the best case scenario, like that's like amazing. But even as it goes up, you can see like, even if it goes like up a lot, you're still gonna be up like $1,700. So this is a really good bullish strategy, especially on stocks that you like, long-term stocks, you know, just step by step, every single month collecting income and then riding that leap options. Again, it's not a full leap option because it's not expiring in 1 year, but you know, leap option is just something that's fairly long to me. Definition is like over a year, I guess, but for me, even 9 months is good enough. So poor man's cover call is a fantastic strategy, and you can watch more about poor man's cover calls right here.